Have you ever watched your futures position vanish in seconds, only to be hit with this dreaded message: your position has been liquidated? Today, I'll show you how to avoid that, once and for all. Whether you're trading on Binance, Bybit, or another platform, if you're trading leveraged futures, you need this survival guide. So what does liquidation actually mean? When you trade futures, you're borrowing money to amplify gains and losses. If your losses exceed your margin, the exchange steps in to close your position to prevent further loss. On Binance, this is automated. Your maintenance margin is the threshold. Drop below it, and boom, you're out. Leverage is a double-edged sword. With 10x leverage, a 1% move in the market becomes a 10% gain or loss. That means if the market moves just 10% against you, you're wiped out. Always ask, do I really need this much leverage? Spoiler, most of the time, the answer is no. Cross-margin shares your margin across all positions. If one goes bad, it could drain your entire account. Isolated margin, however, limits the risk to just that single trade. For beginners or cautious traders, isolated margin is usually safer. Never go all in. Use a percentage of your capital, say 1% to 3% per trade. Let's say you have $1,000. Using 10x leverage, a $100 position means you're risking $10 actual capital. Use calculators. Many platforms like Binance have built-in tools to help with this. This is where many traders fail. They don't cut losses early. A good trade plan includes a stop loss and a take profit. You want to aim for at least a 1-2 risk-to-reward ratio. If you're risking $50, the potential reward should be $100 or more. That way, even if you're right only half the time, you still win in the long run. Ever been stopped out by a wick? Low time frames and highly leveraged positions are extremely sensitive to volatility. Also, don't ignore funding rates. They can eat into profits if you're holding positions long term. Monitor volatility levels and choose calm market conditions when possible. Here's a list of rookie mistakes that cost people big. Over-leveraging, trading without a stop loss, ignoring position size, revenge trading after a loss, holding through high-impact news. If you avoid just these, you're already ahead of 80% of traders. Let's look at a real case. This trader opened a 25x long on BTC during a pump. No stop loss, didn't account for volatility and got liquidated in 10 minutes. Where was the mistake? Used too much leverage. Entered during peak volatility, didn't define a stop loss or exit strategy.